Let's zero in right now on the bond market after rates jumped to start the new year. Joining us to talk about that is Kelsey Berro. She is fixed income portfolio manager at JPMorgan Asset Management. And Kelsey, 8 basis points move basically yesterday. That's a pretty decent move, but not relative to the downside move that we saw at late last year.
Yeah, so I think we need to take a step back. New Year's basically came early for the fixed income market. So if your resolution was to lock in high yields before the Fed pivoted, you were not waiting until December 31st to adjust your portfolio. You've been doing it for the last 2 months. So I think back last time I was here, it was a few days after the Fed, and the question was, could this rally continue? We said, yeah, we think actually it can continue, but now what we've seen is not just a rally that ran into the new year, it sprinted into the new year. And so I think what you're seeing now is really just a little bit of a breather, a reevaluation. The markets are now pricing in 160 basis points of rate cuts for next year. We don't think that's unreasonable, but a lot has to go right to get that to really happen.
Okay, speaking of sentiment moves and markets kind of getting an idea in their head and running with it, that's what it really felt like after Jay Powell's last press conference, where he spoke. Markets said, okay, those rate cuts are coming and they're coming imminently, and we're running and we're heading right towards that end final point. We're going to get FOMC minutes later today, and that will show us a little bit more about what these Fed officials were talking about around the table. Is there a risk that people look at that and say, oh, my gosh, we completely misinterpreted what they were saying and what they were thinking? Because you had a whole bunch of Fed speakers that came out right afterwards, John Williams and others, Austin Goolsbee, who said, hang on a minute before you're off to the races.
Yeah, so I do think that the Fed is going to push back somewhat. They have attempted to do that, as you mentioned already. But honestly, the toothpaste is out of the tube on this one. The market is anticipating rate cuts, and it's really hard for the Fed to push back on those rate cuts when their own projections are showing 75 basis points of rate cuts for this year. So it's a little bit hard for them to be nuanced. They want to reflect the fact that inflation has come down a lot. If you look at the 6-month run rate on core PCE, it's running at 1.9%. We've never been this close to 2% since the Fed started hiking. So we've made a lot of progress. It's very hard for them to reflect that progress, reflect the fact that they do expect 75 basis points of rate cuts based on their own projections, and then at the same time try to push back on the markets. It's just something that I don't think they're going to be too successful in. Ultimately, what's going to drive the pricing of rate cuts in 2024 is going to be the data. So you look at it as a manufacturing, we have that coming up soon, JOLTS, and then the jobs report later this week.
When you said it was very interesting, because it's clearly from a bond investor's perspective, a lot has to go right for us to get 4 to 6 rate cuts. Okay, maybe arguably things have to go not so right for the economy or for stocks. I also wonder what your thought is on the precision of Fed funds futures pricing if we go out 6 months, right? It's kind of a directionally correct, but we can't really pretend that it's too exact.
Yeah, no, that's great. So one of the things that we've done is we've looked back at what the market was pricing at the start of a rate cutting cycle and then what ends up actually happening. And we looked at not just the U.S., but other developed markets as well. And what we found is that the market actually underestimates the amount of cutting that ultimately central banks deliver. And I think that's really interesting because, wow, 160 basis points, it seems like a lot. If you look back from 1980 to today at all the rate cutting cycles, on average, the Fed cuts over 200 basis points in the first year. Now, sometimes in many of those cases, the economy is not doing well, and that's what's driving the cuts. But in an environment where inflation is coming down and growth is cooling, that's where you get the kind of Goldilocks scenario where you get a little bit of rate cuts to keep the real Fed funds rate steady, but not enough to re-accelerate inflation or reinvigorate growth. And that's that very, very difficult line, that soft landing Goldilocks that they're trying to balance.
Do you think it's highly likely they'll start in March, or do you think it's more likely June, July?
I think it's more likely May or June than March. And that's because we spend a lot of time looking at each month of inflation data. And as I mentioned, we've had 6 months of really good inflation data, all pointing in the right direction. Goods coming down, core services coming down, food and energy coming down. I think you could see a little bit less good news there in some of the upcoming prints. The trend of disinflation, we think, is still very much intact. But like I mentioned, the data, it zigs and zags. The market pricing of rate cuts is going to zig and zag. Right now, the market is fully convinced of a rate cut in March. It's going to come. It may not be March.
What happens if we get a really strong jobs report on Friday? Does that undermine that entire thesis? Is this one of those good news is bad news setups?
Well, I think it's more about the inflation trajectory right now for the Fed. That's what's allowing them to do these, what you could describe as insurance cuts, cutting rates to keep the real Fed funds rate steady, to keep the appropriate level of restriction in the economy. So just one strong jobs report, I think, would surprise the market. It would push back on the March pricing, as we just discussed. But I don't think that it undermines the Fed's credibility in terms of an easing cycle this year.
Even if average hourly wages are up more than anticipated?
So wages is a really good point because it goes back to inflation. I think if wages are showing signs of reacceleration, that is something that's going to put the Fed on notice. We don't see that as the case right now. We see job growth as moderating. We see wages as moderating, especially if you take out government hiring. Job growth has only been about 130,000 over the last 6 months, which is fine, but it's not blockbuster. So what I would be really focused on is watch those interest rate sensitive sectors. If they start to really rebound, then, the Fed may have to consider that their path for rate cuts is too aggressive. But if we're in the situation like we are right now, where existing home sales are at the lowest level since 2010, I don't think we're in a situation right now where we need to worry about that.